Australians are overdosing on debt again. Martin North, John Adams, Interested People. Hello, John.
Hello, sir.
Well, here we go again. Yet more debt, yet more household debt.
Indeed. We have been warning the public for some time about household debt and the dangers of it. And I dare say that, according to your own DFA statistics on rental stress, mortgage stress, confidence among those who have a mortgage, we know that 2020 was a very tough year for those who didn't sort of listen to our warnings in 2018-19, and they got into some trouble. Now, there was some relief through stimulus, but it was a very disruptive year with a lot of financial pressure. And I've spoken to a lot of people across the country, from social workers, psychiatrists, to all sorts of politicians, and the harm of the pandemic, the harm of the lockdown has really come through, particularly in Victoria, because they had the harshest lockdown. And yet, with all the things that we've done over the last few years, we are now back in a situation where Australians are splurging back on debt in not crazy numbers historically speaking, but relative to where we were, say, in 2019, particularly on owner-occupier debt, they are back borrowing quite aggressively. We'll go through some statistics. I know that the RBA yesterday released their statistics for December, and you've done a specific data video for Walk the World. But in the last few days, I've had a chat to a number of mortgage brokers across the country, and one told me that this is the strongest level of activity they've seen in 20 years in the industry. So record inquiries, record applications. There is, depending on the mortgage broker, depending on the location, there is a difference between refinancing and new debt. But in sort of one of my friends who's a mortgage broker in Northern Sydney, very aggressive 7-figure mortgages, and people are, people think that the worst of the pandemic is over. 2021 is going to be great. And I should say that's why we started off this year's programming talking about COVID-19, because if it's not over, there is more pain to come forward. But we'll get into some of these issues. But the key point is that the anecdotal evidence and the data are saying Australians are jumping back on the debt wagon in very aggressive numbers.
Yeah, and it's worth just reflecting on a couple of things. The Reserve Bank cut rates, of course, very aggressively. The Reserve Bank was also supporting banks directly by very cheap funding through the term facility. And, of course, the government put a whole bunch of stimulus out there, including Home Builder. So it's not, in a way, surprising. I remember that the Peter Tulip model said if you drop 100 basis points off interest rates, right, that equates to a 30% lift in home prices over 3 years, all else being equal. Of course, doesn't take account of the debt, but that's the model, right?
Yes.
And there's clearly people who think that this is a great time to buy with very low rates, and they're going to ride home prices up as values increase. I'm not sure it's that simple.
Yes. There was an article, and maybe we can put up on the screen when you go through your editing of the show, but there was an article in the last 3 or 4 weeks where the RBA has expressed some concern about too much debt. And they were sort of caught on the 22. You've got the biggest debt bubble in the history of the country. You've got the biggest economic shock since the Great Depression. You're trying to stop the debt bubble from imploding, so you go through the most extreme form of monetary policy in the history of Australia. And now that we're sort of here in early 2021, the RBA is now that they are expressing concern. Maybe we were too aggressive. Maybe this debt is really going to get out of control in terms of this year. And that's why when we did the show last year, I said, even though it is perhaps the most toughest political decision, even in the middle of a pandemic, let the debt bubble go. Let us reset. Let us have a more stable financial an economic foundation, because by adding fuel to the fire, the consequences of trying to clean this up after the fact is going to be very, very difficult.
Yeah, well, it seems to me, John, that no one is interested in cleaning up the mess. Everyone's hoping that they can sustain the mess for a little longer and it'll be somebody else's problems down the road, right? And the argument goes like this: rates are really, really low. That means people can afford to borrow a lot more, and therefore it increases housing affordability and all those good things, right? Except it's not, again, not true. If you look at the home builder initiatives and you look at Western Australia, the homeland packages have gone up by the amount of the stimulus. So there's a zero-sum game. And in fact, the ABS statistics that came out a couple of days ago showed that the inflation rate for new home builds has gone up by more than the home builder package, implying effectively that the construction sector lifted prices by even more than the stimulus in response to the stimulus. So it is a crazy merry-go-round that we've got here.
So, and the key point on that is, even though that the construction companies raise their prices more than the stimulus, because people think they're getting a good deal with the stimulus, it's still sucking people in.
Yeah, absolutely, it is. And it's interesting because I do a lot of one-on-one conversations with people, as you know, through my one-on-one service, and it's quite fascinating listening to people wrestling with this. Well, the government's giving me all this money, right? And everybody seems to be piling in. I should pile in. And I sometimes say, well, just remember, if you buy a new property, a newly constructed one, you've still got to go through the construction cycle. It's very hard in Western Australia to get builders at the moment, right? And you also know that the cost of materials are going up. So this is all going to be more complicated. And existing property prices aren't going up anything like as much as these new homeland packages over there. So it's creating even more instability in the housing sector. And frankly, across the country, you can see some of these same things being replicated. But I will make this point, John. There is a completely different story in the units. Right?
Yes.
There is no sign of price growth in many units in many pockets across Australia. And in fact, all my data and all my conversations suggest that many people with units are struggling dramatically, property investors too. So this is a bit of a focus in on houses in particular areas and particular types of projects. And I think that people are probably missing that nuance of different types of property.
Yes. So I mean, look, the mainstream media likes to focus on high-level property price numbers, but you've always said it's you need to go granular. You need to look at specific postcodes, specific types of property, and then you get a real feel for what's really happening across the country. So just coming back to where we started in terms of 2021, starting with the virus. So. It's no surprise that some of our audience do not like Professor Steele and his point of view and in terms of the virus. But the reason why I thought it was important that we interview Professor Steele again, and we did a 2-part series with him, is because the data is saying something which is very unusual compared to what the mainstream media and government is saying. So on the one hand, it came from a wet market in terms of animals. On the other hand, it came from a lab. And yet you see this explosion in these cases right across the world. And you're seeing things happening at remote islands, ships at sea. And that obviously there is a more... there's a more sort of detailed scientific conversation to be had to get to the real heart of, well, what is really going on with this virus and how risky it is, and have we seen the worst of it, or is it likely to come back in 2021 in one form or shape?
Yeah, and look, John, I'm not going to go into a deep discussion as to whether it came from a meteor shower or whatever. What I can say is that it's way more complicated than being portrayed in the media, firstly. But more importantly, all my data suggests that everybody in Australia is now highly optimistic that we're through it. We've solved it, right? The vaccines will be rolled out, and later in the year, basically, we'll be back to normal. The economy will be booming, which implies, by the way, that international borders will be open. It implies that migration will have started again. It implies that students will be back in the country, right? That's what it all implies. And the question is that really the most realistic scenario based on everything we know at the moment?
Yes, and I'm glad you shaped it that way, because one of the core assumptions that people are using to make this decision around debt is about their view on the virus.
Yep.
People think that we have had good management. But it's interesting that Adam Crichton, the economic editor from The Australian, he had a very good article saying that it's not good management in terms of these control measures lockdown. It's actually we've been lucky. Here's an article that was published on Australia Day, Martin, by Adam Crichton in The Australian, and I'm just going to quote a couple of key paragraphs. Quote, 1 year on from the first coronavirus infection in Australia, we have done a remarkable, almost world-beating job at containing the virus, it seems. COVID-19 deaths are among the lowest per capita in the world. Cases have slowed to barely a trickle. And then it goes on in the article, it says, Dr. Martin Lally, a New Zealand economist who analysed the cost of saving lives from COVID in New Zealand and Australia, said he couldn't find a statistical relationship between the stringency of the government's measures and outcomes. So we have been lucky. Now, there's a scientific explanation as to why we have been lucky, and Professor Steele has provided that. Now, it is true that we closed the borders down, but in other parts of the world, there have been some border closures, and still you are seeing an explosion of cases happening after control measures have been put in. So I'm not necessarily sold that the control measures we've put in is going to save us in 2021. Now, we'll have to see what happens throughout the year, but I thought that given that there is only one narrative being offered to Australians about the virus, and we have a reputable scientist who has 50 years of research behind it, I thought it will at least give some people the opportunity to hear a different point of view. And also we presented some new data that shows that there are some patterns in the data that can't be explained through the normal narrative. So that is that I think is a huge problem that we have to factor in. Now, there is another aspect of data I just want to bring to people's attention, because again, it actually provides potentially some additional support for Professor Steele's thesis. It's not definitive, but it is very, very interesting. So this is a social media post I found on LinkedIn by a Melbourne medical professor, Professor Erwin Lowe, and he talks about, so we know that according to our show that we did with Professor Steele, where Europe and the UK are seeing a third wave explosion in cases, and one of the key things that this professor, who doesn't actually know Professor Steele, published with his own analysis, is that vitamin D deficiency is a huge determining factor as to whether people are actually going to be affected by the virus or not. But then when people have done some regression or some statistical analysis, and what they find is that there is a strong correlation between where these explosions are happening and latitude, not humidity and not temperature. Now, why is latitude important? Is because people can go back to our interview with Professor Steele from May of last year, and he said that this virus was traveling along a 40-degree latitude across the northern hemisphere from Wuhan to Iran to Italy to Spain into New York. So again, I'm not saying that this is the definitive proof that this is coming from a meteorite strike that happened in central China, but again, if this is a lab-created virus, or if this has come from an animal in the wet markets, why is it that this virus is exploding along a particular latitude across the Earth's surface? Again, for those who think that what we've presented earlier this year is complete nuts, and there are quite a few people who don't like what we presented. You as a Australian who's looking at this independently, you need to answer this question. The data is saying this travels along a latitude. What's the scientific justification for that? Because again, I'm not a scientist, I'm an economist, but this to me seems very peculiar compared to what we've been told by the mainstream media.
Well, again, I can't judge other than to say 2 points. The first is that, of course, all the vaccines that are being rolled out at the moment will hopefully stop people getting so sick, but it doesn't necessarily restrict the transmission of the virus, right? So even once the vaccines are out, the virus is still potentially around. And the second point is, you can't open up the economy without the rest of the world opening up their economies too, because effectively international transport and travel can't operate unless you've got pretty much activity that's actually mirrored around the world. So if you're getting these outbreaks, whatever the cause, in other areas, it's going to be a break on our ability to get our economy back to normal.
Yes.
So, like it or not, I don't think the game's over.
Yes, the only point I would make on that, Martin, is that so I agree with you that we're relying on international factors for the international border, but obviously the way politicians have been behaving, not only in the last few weeks, particularly in, say, in Queensland, where they had an immediate 3-day shutdown because of a mutant strain, but given what we saw last year. Even though I don't think the data supports a severe lockdown, if we did all of a sudden see 1,000 cases spike up within 24 hours, we would see a complete shutdown of the economy because, as what Professor Steele said, people misunderstand the infection model. So now we'll get into this slightly later in the conversation, but one of the things I've said so far this year is the key financial priority I think that I'm doing for myself, and I think other people should adopt, is remaining as flexible and nimble as possible, because I think there's the chances of very sudden changes in employment and income, cash flow obligations can be very large. And if you have gone out thinking everything is fantastic because you've listened to the mainstream media and you've engaged in very significant cash flow obligations like a new mortgage, that could be very tough to handle in 2021 if that assumption that everything, the worst that's behind us, doesn't actually come to be.
Yeah, and that's why, John, I continue to run my multiple scenarios, right? Because I think the best way to deal with this is to say, what if this happens, what if that happens? And the answer is you get very different outcomes in terms of employment, in terms of home prices and risk and all those things. The other factor there is that a lot of people that I speak with, again in my one-on-ones, don't actually do the counterfactual thinking. In other words, what if this happens, right? What if I lose my job, right? They sort of just go on to it's easy, I can get money, I should go buy, right? And I sometimes pose them the question, well, what happens? How would you deal with a job loss, right? If your income suddenly stopped, would you still be able to service the mortgage? And it amazes me how few people actually have any answers to that sort of scenario. So again, I think you're right, agility, flexibility, run the counterfactual and see how it would be. Don't just get swept up in the enthusiasm and, frankly, the fear of missing out. Because, as I sometimes say, there's always more property. There's always going to be more property.
Indeed. Now, we're not going to harp on the data a lot because you've done a separate show on Walk the World. But two graphs I think are worth calling out. So let's put up slide 3. So this is annualized owner-occupier housing credit growth. You've done some shows on Walk the World with Steve Keen, and Steve Keen's analysis is that credit growth is the key determining factor for property prices. And so particularly when we did a number of strong shows in 2019, we could see that that housing credit for owner-occupier housing was falling, particularly from the peak in 2017, and we thought that could really slow up the entire sector, could push prices down. You could start to see unemployment in construction and a whole host of other things if people were not borrowing to feed this bubble. But obviously what we've seen from over the last 18 months for owner-occupiers is that it's not, I wouldn't say it's explosive growth, but there is an uptrend in the annualized growth for housing. And so the December number was 5.6% annualized growth, and that's the fastest annualized growth rate since February of 2019. So almost 2 years in terms of the pace. And one of the key points that we spoke about off camera was that this graph and these numbers that we're talking about is the RBA has numbers about how much credit has actually flown into the economy in terms of actual dollars going out into people's balance sheets, and yet there's a timing mismatch between those who get approvals and then those when they actually get the money. So if mortgage brokers are saying to me that they're getting record number of mortgages approved in, say, December, January, the money will actually flow through to households February, March, April. And so given that time lag, I'm expecting to see even a further pickup in housing growth for owner-occupiers over the next 2-3 months.
Yeah, I agree, John. And, the rate of change of credit is the thing that drives home prices. So that's why in my scenarios, my main scenario is now showing price rises over the next few months, which is different from a few months ago where I was thinking the impact on the economy would be stronger and the unemployment would be higher. Currently, I think that the very low rates and the freer credit availability that's there now is sufficient to drive prices higher. Not dramatically higher, but somewhat higher.
Yes. And so we did a show on this channel back in June of the 19th of June in 2020, and I said house prices are unlikely to collapse over the next 18 months. And what drove, and people can go back and look at that program, and what drove my view on that occasion was that this unprecedented amount of stimulus was going to put a floor underneath the market, and so far 7 months on, that has proven to be correct.
Yeah, and look, my theory has always been that this is partly to do with the election later in the year, right? So conveniently, prices could well be rising just at the time when they go to the election. Well, that could be quite useful for the people in power at the moment.
Indeed. Now, if we go on to slide 4, we have annualized investor housing credit growth. So this is just for investors. And so what we can see is that over the last few months, the annualized growth has been falling. So what that means is that the amount of debt that property investors have taken on to invest in property, that has been shrinking as investors have been withdrawing from the market. But the growth or the pace of decline in the pool came to a halt in July, and so since then, what we've seen is that it's still shrinking in size, but at a slower rate.
Yep.
And what that indicates, if you look at the monthly numbers, is that you're starting to see some additional investor activity, and that sort of confirms some of the conversations I've had with mortgage brokers to say that, particularly for some of these house and land packages, but also interestingly out of Western Sydney, I heard that there are some investors looking at some land banking.
Yep.
So there are some vacant land. They're thinking it's a good investment to purchase the land, hold it for a future point in time on the basis of capital growth. And so there are some investors who are enticed by those opportunities, and obviously some of them are looking to get finance to fund those investment activities.
Yeah, and I agree with that, John. But I'll also highlight the fact that certainly in Sydney and Melbourne, there's very little investor appetite for units. Prices are still falling. There's still big issues with regards to the inflammable cladding. And I've been involved in a few of those particular conversations quite recently, as well as structural flaws in some of these high rises. And there are a number of property investors sitting on values that are down 20 to 25% from where they were even 2 years ago. So again, need to go really granular, to look at what's happening with property investors. A lot of it's houses, a lot of it's home land packages, and as you say, land banking is also there as well at the moment.
Yeah. So you, like kind of like what you said, there is a clear bifurcation in the market between in terms of houses and units.
Yep.
And it'll be very interesting to see how that plays into how that plays over the next few months, and whether investment apartments can actually find a floor, and where will they stabilise that?
Well, that goes back, I think, to international borders. If the international borders open and we start getting students coming back and people who want to live closer into the city, that will put a bit of a floor on the investment property, because a lot of the investment property in the high-rise sector was temporary, students and those sorts of things, right? So if you look at, for example, inner city Melbourne, inner city Sydney, there are vacancy rates of 12 to 14% in some areas, and the rentals have dropped by more than 10% in some areas. And in fact, I was talking to somebody yesterday who has a portfolio of investment properties. He's offering rents 30% below where they were a year ago, just to try and get anybody in.
Yes.
Because none of the people that would normally be getting those properties are around. As I say, if the international borders open, that changes, which is why it comes back to fundamentally the question of what's going to happen with the virus and when will the economy open up internationally.
Indeed. So a couple of additional observations from me, Martin. So I would agree with your early observation that what's driven a lot of this activity in credit growth has been interest rates. Now, I have asked a few of my contacts about lending standards, and so far there hasn't been any material decline from what they can see. A lot of these loans are still being financed on a P&I basis, not in terms of interest only. There are a couple of examples of people being financed at a 95% LVR, but I wouldn't say that is the norm. But there is some now, and to be honest, I'd be even at this stage of the economy. So I was on the phone with a mortgage broker from Perth, and they was talking about 95% LVR, and some banks were willing to finance that. I was somewhat surprised, but and I personally think that would be a little bit risky for the banks, but some banks are enticed to go to that level.
Yeah, and some of the non-banks particularly are being quite aggressive at the moment. So again, some of my conversations with individual borrowers, they couldn't get what they wanted from the major banks or the regional banks, but by going to the non-banks, they were actually able to get a higher loan-to-value ratio, and they paid slightly more in terms of interest, but still very low on absolute basis. So it is feasible to get high loan-to-value ratio loans at the moment. And there's huge aggression in the market from anybody trying to get a loan, because all the lenders want to give money away, right? So it's an interesting time to negotiate. You can certainly negotiate pretty hard.
Yes. One interesting question for you, Martin, is that so to my mind, and some of the feedback I've heard is there are, it's not, well, it depends on which part of the country, but for example, I've heard that in Western Australia, we are seeing some quite aggressive activity of people drawing down on equity to finance what economists would call conspicuous consumption. So whether it's a nice car or a jet ski or a boat. So there are, so here's the thing, if you're on a variable mortgage, refinancing doesn't particularly make a lot of sense because you're going to enjoy the low interest rates anyway.
Be careful with that, John, because a lot of people are still on a mortgage with a 3 or something in front of it, a variable rate, but the margin above the variable rate is still a lot higher, right? A lot of people have not switched to the best variable rates. So I would suggest that even those on variable rates should check to see whether they've got the very best rate they can.
I see. Okay. So those who are refinancing are just not trying to lower their interest costs. Some are actually borrowing more and taking the opportunity to borrow more for either renovations or for or to buy in terms of additional things. Now, we haven't talked about personal credit, like in terms of non-mortgage debt, but one of the big factors for that is that that's been according to the official statistics, that's falling through the floor, and it looks like it's now stabilising. But there's a huge issue there that services like Afterpay and Zip Pay and all this other stuff they're not included in the statistics because they're not considered to be a credit product. And I've heard anecdotally over the last 6 months that people who apply for a credit card and get rejected, they then go to Afterpay. So there is a lot of borrowing for personal consumption, and that is another factor which unfortunately official statistics don't pick up, but there is activity in there happening across the country.
Yeah, and there's a definitional issue, right? So if you're actually using a debit card rather than a credit card, and you have 4 period payments to make over, let's say, a month or 2 months, depending on the particular facility, is that credit or is that just delayed payment, right? Because there's no interest being charged, right?
Yes.
And that, of course, is the argument put in into play by all of these buy now, pay later firms. It's not a credit product at all, right?
Yes.
However, it is definitely changing the characteristics of the way that people manage their finances. And I'm seeing my surveys, again, I do quite a lot of work on this, of people having 3 or 4 or 5 different facilities with different buy now, pay later providers, and have quite significant balances outstanding, right? And so it is a form of credit. It's just a very different form of credit, and it's not reported in any of the official numbers.
Yes. Now, one of the things that was said to me that I found fascinating is that the virus has actually changed some people's their psychology and their outlook on life. So some people, particularly out of Perth, have said, well, some people were thinking about buying a property over the next 3 or 4 years. I could be dead. People are dying all over the place. Life is too short. I want to live in the moment. I'm going to go buy that property now, and I'm going to actually get my life back on track according to whatever their objectives are. So I don't know if you've picked this up in any of your conversations, but apparently the lethal risk of the virus has now caused some people to take action straight away.
Oh, it's changed behaviour quite remarkably. For example, people are thinking maybe I should move out of the city and live somewhere away from the city, because I don't have to commute so much and I can virtual work, right? So that's the first thing. The second thing, if I'm going to do it, I need to do it now. And look, I might have been thinking of travelling for a year or two or going on extended holidays. All that's off. So I'm now going to focus on perhaps buying that property that I was thinking of down the track. And as you say, there's a bit of a hedonistic thing going on, saying, well, none of what's going down the track, so let's just enjoy ourselves while we can. That's definitely coming through in the surveys.
Very, very interesting. I personally haven't thought along those lines because I've never considered the risk of COVID-19 from a lethality point of view to be as serious as what we were initially told. But there you go. But and then just the last observation I'll make is that so we did a show last year where I was critical of Steve Van Meter and talking about his deflation thesis with all the stimulus. Now. Even though I don't agree with what he said, one of the things he did say is that the way that money printing becomes inflationary is if the banks lend. And I think he was more talking about the American situation to say that there's no evidence that the banks are lending in the United States. Well, given that we're seeing positive growth in terms of credit to housing by Australian banks and Australian financial institutions, even by Van Meter's own definition, this should be inflationary. And I think I still hold that we are experiencing stagflation, and there's more to say on the stagflation front in a future episode. But I think that even Van Meter would say that if the banks are increasing lending and the credit that's being issued to the private sector is growing, that should have inflationary impacts. The question is, to what extent is it going to be inflationary?
Right, and if you go back to the whole broad money conundrum versus credit, right? Broad money is grown about more than 12% over the last year. Credit has grown just a little, right? So the question is how are those two things going to play out? I haven't yet, in any of the data that I've seen any evidence of inflation yet. But, we'll keep an eye on it. So I guess, John, you were saying a little while ago about people should be really, really cautious, and I agree with you there. And the problem is, I think that people can get swept up in the moment, swept up with all of the high-level headlines. Just remember a couple of things. The media are not necessarily painting the whole picture. They tend to be quite selective in the way that they're presenting material, and of course, the politicians are trying to talk the economy up. So I guess my question to you is, how do we get the balance? How do we find out where truth lies in all of this?
The number one thing I recommend people to do is switch off in terms of the TV. I mean, one of the things I'm focusing on a lot this year is psychological warfare. It's a personal interest of mine, and whether we talk about the U.S. election or COVID-19 or even the economy, what you and I have been engaged in for a number of years is providing a counter narrative to a systematic attempt to brainwash the public to say that debt's okay, there is no risk. And so one of the great things about the internet is that you have the ability to select which voices you want to hear and which narratives and that you want to analyse. But when it comes to the Australian TV, it is tightly controlled. It is systematic propaganda. And to be honest, 10 years ago, 15 years ago, some people would say to me, I don't watch TV. And I found that very odd. Well, now in 2021, I don't watch TV anymore because I just don't trust it. I don't think it's providing me with useful information that I can then sort of make some life decisions on. So I would say turn off the propaganda. Try to get into the issues. Now, I have a maths background. You have you're very heavily on data yourself. So we can look at data sets like around the economy or COVID-19 and sort of say, well, what is this data set saying to us? But I dare say that people should try to do their own research. Try to think of who's more accurate than not. Try to follow those sort of things, and obviously just try to take common sense decisions about kind of like what you said. When I had a mortgage, I always had that what if question in my own mind. If I lost my job, how long can I survive before I would have to give the keys back to the bank? I mean, these are, now some people would say that I was overly pessimistic, but this is how my mind has always been, the what if scenario. So I think that's very useful, that people should have that sort of mentality. And again, people should hope for the best, prepare for the worst. And preparing for the worst could mean in 2021 more lockdowns. It could mean more disruption in the financial markets. And even if in the US stock market, we've seen since Biden has come in that the market has fallen about 2-3%, and we'll have to see how the US stock market how that continues with all these new policies that Biden's got to bring in. But there could be some bad economic news. There could be some lockdowns. There could be some disruptions to employment, income, and cash flow. And people just need to be cognizant enough to understand what the real risk profile is, and then try to adjust their circumstances accordingly. Because I think in all this conversation and this journey that you and I have had together it's a question of a lot of Australians just misunderstanding in terms of risk, and what's the real risk profile of getting into too much debt and not having a safety buffer when things when things become disruptive, like what happened in 2020.
Yeah, and John, the last point from me is when you go to the bank and the bank gives you a chance to get a mortgage, right? Remember that the bank is assessing the risk from their point of view, not your point of view, right? Yes. So they're wanting to make sure that their credit risk is okay. Doesn't necessarily mean they've considered whether you are actually able and willing to make the repayments and whether you've thought through the various issues that you should have thought through, right? And in fact, of course, the responsible lending legislation might well be swept away later in March as well. So the point I'd make is just because the bank says you can get a mortgage doesn't necessarily mean you should get a mortgage. You've got to do the work. You've got to think it through and ask yourself some hard questions is my advice, particularly in the uncertainty that we've currently got.
Absolutely.
John, I appreciate your time today. Really interesting and important conversation. And I guess we're going to pick this up again because I think this year is going to be a bumpy ride.
Absolutely.
Martin North, John Adams, Interested People. We'll see you next time.